Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. Well, it is already Thursday, believe it or not. Wait, it is Thursday. Yeah, it's Thursday. Can you believe that? Anyways, we're gonna have, the typical jobless claims, etc., tomorrow. Huge day. And yesterday, pretty messy. So let's talk about what happened yesterday, shall we? Oh, when is it not night here? Oh, there we go. Okay, we're fine. You're still with me, right? Yeah. Okay, everything's fine. My computer made a noise. I don't know what that was. Okay. Well, so when we look here at the treasuries yesterday, we had a decent move up. So I tell you what, this was super effing frustrating. I bought it here on this wick. We came all the way back down. They were like 3 ticks away from me bailing, but I held on. And we moved all the way up. Now, I did not hold that all the way. I got a little bit past break even and was like, I can't, hold this all day. So, but it looks like I was correct and the entry was just absolutely terrible. But now look, in the overnight, we're back to where we were. So the treasury market is now holding their feet to the fire a lot more than they were. And I think that's a really important thing for us to keep in mind here. Yesterday, part of what was having me hold on was the way that it had been so favorable to uptrend in the past. So, ES, a small down day yesterday. And then, they're still kind of in the hole, but nothing big. Oil, big mover again. Moved up pretty aggressively yesterday. Gold and silver still kind of in the hole. Kappa declining a little bit, but it's just a little messy over there. And then when we get over into currencies, the dollar still around 102, so about where it was yesterday. So the dollar is showing some strength. Not a complete turnaround, but it is starting to show some strength. And the Japanese yen is starting to look a little weak here. And then you got Bitcoin over here. Jumped at the beginning of the week, fell over here. Apparently, this was a relatively prominent Bitcoin analyst suggesting that the ETF is not actually going to get approved. I am still of the opinion that I cannot believe that they would approve a Bitcoin ETF, given the reasons that they rejected it before still hold. I think that the reasons that they had were good reasons. I don't think these court cases that kind of force them to look at it again would change their mind. Okay, but with all that said, all of the rumors and the analysts and everything are saying that I'm wrong. So whatever. I'm sticking to my guns. I'm not going to make a prediction, but I'm sticking to my guns and saying they should not approve a Bitcoin ETF. So, by the way, we kind of thought that we would already get the approval. Like the rumors were that it would happen this week. It's already Thursday, so we'll see. The longer this goes on, probably the more likely they get rejected, right? I would think. Okay, so by the way, I'm on time today. Are you proud of me? I mean, not on time, I'm early. Sometimes I get in here and it's like 6:30 and I'm like, what the hell? Why did I take so long? All of these sorts. I'm doing pretty good this morning, so I'm happy about that. Okay, so for the news, we have US initial jobless claims coming at in 5 minutes, and the expectation is 125, which would be up from the previous reading of 103. You know what? For this one, I think we should come over to Forex Factory and look at the graph. So here we got unemployment claims. Okay, so they're expecting 125. Oh, 216, sorry. 216. And you're saying that the last time was 103? How come I don't have that one on here? This one was... Okay, so two... Oh, sorry, I'm looking at two different things. Initial jobless claims, 216. I mean, that's kind of pretty close to where we've been, so 216 wouldn't be a huge deal. But if it was higher than that, that would maybe rock things a little bit, wouldn't it? That would rock the boat a little bit. Oops. Need to turn off the speakers there. Apparently they're having some site issues with Financial Juice, but that's okay. We'll pull up TweetDeck here. Market Ear tweets low volatility is beating high beta so far this year. I haven't seen tweets from the Market Ear in a long time. I thought that they went dark when they got their zero hedge thing. That's cool. Morgan Stanley Wealth Management reduces position in Advanced Micro Devices Incorporated, AMD. Interesting. This alleged 1.3 billion crypto scam likely faked its own CEO. Wow. They're getting up into the billions now with these scams. What? You can become a billionaire by scamming people on Bitcoin? I would never do that, but I'm impressed. I honestly am. SEC just submitted the recent SEC versus Terraform decision, finding that UST and Luna were securities as supplemental authority in their case against Binance. Okay, 1 minute left. Yeah, I should know, we did have the ADP, right? And that's, I think, why the treasuries got pushed down a little bit there. I don't have the number here in front of me because Financial Juice is having some issues, but I'll sort that out in a bit. Okay, so a pretty decent pull on the liquidity here, but the micros are still like reasonable, so that's interesting. Okay, so we got 202 versus an expected 216. Yeah, that is going to push the treasuries down a little bit. Let's see how far they go. I don't know if that number is enough for me to want to be taking a trade on this, especially since they came back to that 112 there and bounced a little bit. You know, round number, the sellers stop. That's a little concerning to me. Or that doesn't give me a lot of confidence that the sellers are just going to keep pushing. But you never know. It's just pretty tepid volume so far. Okay, so this is some revisions, but relatively insignificant ones. Let's see if I refresh here, if I get the ADP now. Ah, no, I don't. I shouldn't have done that. Oh well. ADP. Oh, ADP was 164 versus 120. Okay. Although we got to keep in mind that the ADP doesn't matter because it's more and more disjointed from the non-farms number that we get. So, well, I should note that the 30-year did get pushed down a little bit harder than on that. So they steepened just a tinge. They steepened just a tinge before the 5-year, kind of started dragging us below. So let's see. I'm getting a decent amount of absorption on the bid here as well. My voice doesn't sound very good today. I'm sorry. And maybe I need to start hacking and coughing a little bit more, and then it'll clear up. How come market participants react to news the very second the news gets released? Because speed is a big advantage. I think there are actually a lot of robots out there that are set to read the Bloomberg news feed, and as soon as that number comes through, they make decisions based on that number. Like, you could come in and you could program something to say, okay, if it's higher than expected, sell it. If it's lower than expected, buy the treasuries. And, it could do that instantly. But then there's also algorithms that have much more sophisticated stuff and look at the number versus the expectation and all this sort of stuff. But there's robots that do it. Some people are just really fast. Okay, they did get through 112 by a tick. Still pretty decent bids. The amount of volume that's come through to sell this has not been a lot. It could cascade. It could do one of those things where they keep pushing and it just gets worse and worse and worse. But I don't know if that's what's going to happen. By the way, that reminds me. I don't know why that reminds me, but I did have some vendor licensing stuff I wanted to take care of here. So. That's weird. Yeah, I had someone that needs to switch machines, but NinjaTrader licensing is having some problems this morning, so I'll have to try again later, I think. Trying out UB on a combine? Ooh. Hey, well, I tell you what, I think that UB could be a really good instrument to do a combine on. I mean, it kind of depends on what your approach to the combine is. I've kind of come to the place where I feel like that if you're going to do a combine, do degenerate stuff. You know what I mean? Like, because you can go in there and pull money out in the short term, and then when you blow the account, you just lose the account, but you keep the money that you pulled out, right? So you can do things like, take risks that you really shouldn't and that you wouldn't do with a live account, right? And trading UB is one of those degenerate things that I would do, right? Because it moves very fast and it's a thick tick, Like this move down in UB was probably $250. You made any? I don't really do the New Year's resolutions things because I always got goals going on. Yeah, there are always things that I started working on before New Year's. I am starting to get more and more enamored with this idea of starting a fund of some sort. You're testing a 5-tick trailing stop? Yeah, that could... I don't know. So... when it comes to things like stops and stuff like that, what I find, especially in the treasuries, is that your stop influences so much about the performance of your strategy. That's why you notice, like somebody yesterday was asking me, why don't you have a stop on there? And I said, well, we're only talking about $10. And, this is a pretty illiquid instrument. So if there is like a move against me, I don't necessarily want to like just immediately stop out. But part of it also is I'm playing a little bit more loose with my risk. Because I know that taking on more risk does tend to result in more profits, but that, when you come into like the high volatility time, that sort of a thing, that's going to screw you over, right? So I have to, but I'm experienced enough now that I can make a discretionary decision about when I want to take on more risk and when not to, right? The looser you can play your stop, generally speaking, the better you're going to do, right? Now the split side of that is that with the kind of trades that we're doing, your best trades should go in the money fairly quickly. So but like for instance, a trailing stop, just as an example, I'm not saying that a trailing stop is a bad idea, okay? But if I'm like back testing a strategy and I add a trailing stop, it will almost always reduce the total profit, right? Because there's going to be a certain number of moves that went up and then came back and hit the stop that then would eventually go on and push up and go further. Can you play more? No, I wish. I saw this video from Brett Cooper, the girl that looks a lot like Ben Shapiro, and she's on the Daily Wire or whatever. She's like their Gen Z, their new kid, and she was doing a test to see if you were gay or not, and like the first question was like, what's your favorite color? And then your second question was, what's your favorite Mariah Carey song? Right? was like, okay, these are weird questions. And then the third question was like, do you like having gay sex? And she's like, why is the other questions even in there? I thought it was a funny video. Oh, did they move? Yeah, they did move a little bit there, didn't they? I did notice when they moved to third, then when they moved below 112, but they made another 2 ticks, I see. But not on a whole lot of volume, so I don't know if that's really one that I want to follow. I am, well, below 112 though, you know. Well, I don't know, guys. This is a little tough. There's still a lot of stuff below us. So below 112, yeah, let's come back over to the charts here. So this is where I got to be careful, where I would, you know, want to read something into levels and so forth to try and predict the futures when it doesn't. But it does tell us a little bit about what the current conditions might be. And so the big thing that I think I need to keep in mind here is we are on the downside, but here's yesterday's low. And then you got all the way down to here where you have like single prints. So basically there's people that maybe they took a position from the FOMC or whatever. They're watching these levels, right? That means to me that we could get some downside, but I think there's going to be some absorption against it. We did see some absorption when we broke like the 112, for instance. I'm going to keep an eye on it, but you know, I think it would be very difficult in this situation to have like just a dumpster of a day that all of a sudden popped out of nowhere and went all the way down and started retracing this FOMC move or something like that, right? They're going to save that for tomorrow for the FOMC. So, and that's why seeing this little move, like one little, you know, slip lower on relatively light volume, okay, maybe. But like when it starts saying, oh, I'm just going to slip all the way down, probably not going to happen, right? We'll take that into consideration going forward. Yeah. So going back on that thing, it is the conundrum, right? It is, and this is especially true on short time frames. Okay, when you're getting into like daily strategies and stuff like that, it's kind of a little bit of a different game, and this sort of thing maybe doesn't even matter. Okay, but on short time frames, the more risk that you can take on, generally speaking, the more money you're going to make. At least in the short term. The long term, it's a different thing. That's why, like, you know, one of the things that we'll see a lot is people will say, I'll have a 2-tick profit and a 4-tick stop. Well, if you do that, you're going to win like 80% of the time. But there's going to be like this 1 month where that your setup's going to lose like every freaking time, and you're going to lose twice as much on that losing streak as you would otherwise, and then you're going to blow your account, right? And we did this yesterday, right? Yesterday we held a trade 50 ticks against us. So that was a bad trade, no matter which way you look at it, and I have to own that, right? But I felt very confident that it would eventually turn around. I don't know why I felt that confident. It was probably false confidence. I don't know, but it did. I was right, and it actually went way further after that too. So I was right. As like, I guess you could say the entry was just really, really bad. I should have waited for everything to clear out first and then gotten in. Okay, but that was me taking on risk with knowing that what I'm doing is kind of degenerate. If this is a tail event, I'm going to get absolutely screwed, but I don't think that it is. Right? You got to think of it as like your edge is going to come from the edge. And you want to only be trading when you've got something that really gives you an edge, okay? And I mean really gives you an edge, because if you're going and you're back testing it or whatever, and it wins like 52% of the time, that you don't got nothing. Okay, if it's like equal risk reward and you win 60% of the time, I mean, that's a little better, right? Or you know, you win 50% of the time, but when you do win, it goes twice as far. That's what I try to do, right? But you need to have an explicit edge. When you have an explicit edge, taking on the additional risk is kind of the sweetener that can bring your results into, you know, fruition, or, you know, that's the sweetener that can give you results that are actually impressive, that you're looking for, essentially, right? Most of the time I don't do that. Most of the time I'm just straight 1-to-1, and you can see, like, I do okay, but like trading one contract, you're just paying for commissions and data and stuff like that, right? But it's when you start doing things like adding contracts every step of the way, doing multiple contracts and taking sequential profits on it so that you can let the other contracts ride. All of these ways of manipulating your risk reward are the ways that you can really start to make big money. It's just that all of those things are also things that can totally screw you over if it's a fat-tailed event. Which means you're kind of building yourself up to the only thing that matters is how you deal with the fat tail. Notice I do better when highs and lows look more like a letter V. When they look more like a letter U, I do worse. Yeah. Well, but that's probably just the inverse sine law, right? The inverse sine law is basically, well, we talked about that before. You know, you have a move down in cumulative delta. Come on. There we go. We have a move down, and then we have a move up. And like if this is cumulative delta, it's the same amount. The tendency will be that the second move will be further in price. So when you're catching these V kind of moves, those tend to be your best trades. But you know, this is actually kind of a situation where I would maybe be looking for one of those, right? As I was saying, I kind of feel like the downside is a little bit limited. If I saw something in here that suggested to me that there was like big player aggressively pushing back, yeah, I would want to get on it and go for the reverse. Although the best ones on those are going to be like, there was an economic number and you think the market is going a certain direction because of an economic number, and then a piece of surprise news comes along that will push the market the opposite direction. And when you take the opposite on those are great trends. Because you get the inverse sine law where you come back over this area while the liquidity is still damaged, and then on top of all of that, you get all the people that were short have to puke the position. So then you get really strong market orders coming out the other side. Okay, how do you suggest going about reading trades, quotes, and prices? Is it more like a textbook than a book you read? Yes, 100%. If you pull the book out before you go to sleep, you will just fall asleep. You'll probably just fall asleep. And a lot of it depends on how you are as a person. But most people, when you start seeing formulas and stuff, your brain just like shuts down. He goes, well, I understand that. I don't want to understand that right now. I'm not going to engage that part of my brain. Right. So I would sit down. I would sit down at the kitchen table or at your desk or wherever where you've got a flat surface in front of you. You have the book out. You have a reading light. You have a notebook, and you can write notes in your notebook and do all of that stuff. And this is a book where you don't necessarily have to understand all of the calculations to get the knowledge that you really want to get from the book, right? They're so good at summarizing what are the consequences of this model that we have and what did we learn from it. They're very, very good at that. So you can read the chapter, go back and learn the formulas later if you want to. Always have your trading platform opened every few pages to get new ideas. You probably will get a lot of ideas. Like it gets so one of the things that stood out to me when I read the book is like every little part of that is something that you could potentially incorporate into a scalping algorithm. So, and now you can kind of see how the algorithms that high frequency traders use can be so like so effective because they're looking at, you know, it's just like one layer of thing on top of another, you know, and it's really, really hard to do without a whole army of software developers to support it. It's really hard to do it on your own, but you know, it really gives you a good idea of how it works. And I kind of look at it more as like, okay, I know how the robots work, and now I can see the behavior over here that like, okay, it ticked up. There was hardly any contracts on there, and I saw the limit orders adjust very quickly. That's probably, and then I saw, you know, the Japanese yen moved also. So that's probably all of the robots adjusted what their best bid and offer were based on that correlation, you know, and now I understand. Okay, that's why it moved up. So that move up doesn't necessarily tell me anything about the supply and demand in the treasuries themselves, other than in relation to the Japanese yen. And when I want to take a trade, it's probably going to be there is just strong demand in the treasuries and it's going up, so I can just kind of ignore that one, right? Makes sense. My knowledge of statistics is not as strong as my calculus, so I get stuck on trying to understand every line of math proof. Yeah, and you know what? They don't have too much of the complicated statistics in it. Like, it's when you start getting into like stochastic calculus that I get lost. Okay, so when they ticked up through 112 even, there was a really strong bid that followed it up. Yeah, 228. So we saw 228 add and then pull off of there, and then a little bit add on 0.0 half. That looks like has already traded. So, you know, or earlier I was saying, you know, if we're getting like strong pushback against this, that might be a really good move up, sort of a trade. Well, we are kind of getting that. We are kind of getting that. It's tepid, right? So remember, oh, hold on, music stopped. The thing that I really want to see is autocorrelation and cumulative delta. Okay, so here, it's a gentle upslope, and then we got this one big one. Okay, so is that enough on its own for me to take a trade? I mean, I suppose it could be. But, you know, it's not a whole lot of data for us to really know for sure. And I'm not exactly sure what the flow would be that would go long. I just know that the market situation is as such that we could see some buying. But I don't have anything strong enough to tell me that they're you know, I really should expect an imbalance in that direction. So I'm going to need a little bit stronger of a signal than that for me to want to do something. But that said, it was curious action, and it is something for me to take note of. I don't think that at this point I'm looking for shorts. I tell you that much. Oh, Shanader in Discord is saying that they were pulled up my YouTube, and before it pulled up me, it had an advertisement that says the only way to do it is to automate it. That's funny. Have you tried? Well, yeah, that's exactly what I think that's exactly what we're trying to do. The way that I approach this is like if you were looking for a okay, if you wanted like a real setup, okay, the sort of trade that I tend to take is going to be, I look at what's coming in today and things that I think are going to cause buying and selling, and I combine all of those things together and I say, is there an imbalance? Okay, so if there is a strong imbalance and I'm not getting signs from the market that the market really understands that and is pricing that in, that's the first thing that has me coming in and is like, oh, we might be taking some trades today, right? So then I'm trying to predict the autocorrelation, right? So the first thing that I'm going to be looking at is kind of these tea leaves in the DOM. How is the market reacting to the latent liquidity? So I'm watching every time that it ticks up and down, what does it do? So in this instance, just for example, we had like a 2K, a 3K, a 3K pushing back up to 112, right? But then we've had another 2 ticks back down pretty quickly on less than 1,000 in each one of these instances. So what does that tell me? The latent liquidity on the bid side in this area is pretty soft. There's like a liquidity hole. They kind of pulled themselves out of it and they just fell back into the hole. So could I take a short? I guess I could still take a short, but the flow was long. Okay, but then the other thing is, what are the market orders? What are the market orders and how does this react to it? Because if I'm seeing aggressive market orders and these are just pulling out of the way, that's like a really good sign that, okay, they really know something. And if it's in line with my larger bias, then I'm starting to look for a trade, right? So if I take a trade, so the first thing is I'm looking for something that's going to give me like an advantageous position. Like if I was really, really confident in a short, that kind of push up where like the strong volume came in there and everything, that would be a good place to try and push it down, get in and see it come back down. And vice versa, it came in here, it was soft. If I want to buy it, great place to buy it. There's an iceberg there. That would maybe be my entry. That would maybe be my entry if I was really confident in a long. Okay. Once I'm in that, what I am essentially doing is I'm making a prediction. I'm trying to predict that autocorrelation, and what I expect to see from that point is cumulative delta go like this, right? And the more that the cumulative delta looks like that, the better of a trade it will be. When you think other traders know something, do you try to know what information you are missing before you get? Oh, yes. So if like in this instance right now, I have some idea that there's going to be some trade in the market, but I don't have an explicit edge that tells me long or short, right? So I'm looking to see which way they're going. Now, right now, in these market conditions, I think you could see some relatively strong orders and everything. Like that 4,000 doesn't surprise me at all. Okay. But let's just say that something really wild, like all of a sudden we're down like 4 ticks, and it was like 4K each step. So like the market makers totally tried to hold it and the market orders just completely blew through it. Okay, that was a really, really strong sign that there's some informed trading out there. And if I didn't hear something on my news squawk or whatever, yeah, I'm a little bit worried about taking a trade in that. So I would really very much prefer to know why that flow is coming through. If I'm starting to see like a strong autocorrelation and I don't know what it is, I find it very frustrating. Now, and this is kind of where I think a flaw in our trading kind of comes up, because one of the best autocorrelations that you get, like the best trends and moves and stuff, come off of these sovereign wealth funds coming through. And I don't have really any idea how to predict them. They were coming through. I'm sure that they were a large part of the selling back in October, right? And it was just bewildering how strongly and how it kept selling and everything. But it was absolutely these sovereign wealth funds coming in and selling. And there's no way for me to predict them, right? So then what happens is Seth just sits here and watches it moves without him and complains about it, right? Hate that. What's easier to read, order flow or women? Okay, what makes Jigsaw so special in terms of DOM trading? Is it the edge it provides with the extra futures? Or did you mean to say extra features? Or is it just accepted by traders because it's been known for a long time? Okay, so this is that's actually a really great question. Like understanding the evolution of the software, I think, is kind of helps you understand why the futures market is the way that it is. So it used to be that trading technologies was like the only game in town, but to use trading technologies it's not cheap. Like even today, it's not cheap. You're spending several $100s a month to use it. And basically, professionals that are managing funds tend to use TT, but the rest of it is too expensive, right? And Jigsaw came along and was like, oh, well, there's some real value in this. And the people that I'm talking to, that's what they're doing. I'm just going to make my own version that's cheap. And that's basically how it started. And when they did that, they started looking through and they said, okay, what are these guys that are using TT actually doing? And then they came up with features that allowed them to see the things that these traders were actually doing a lot easier. And the primary innovation in particular is these two center columns here, where we can see the market orders hitting into the limit orders. And every time that it ticks up, and it's been a few seconds and then it ticks back down, it resets that center cell so that you can see how many orders it's actually taking for it to actually lift the price, right? So the current trades column is the primary innovation. Now, since that time, basically everybody and their dog has copied Jigsaw's feature. Not everybody, but you know, you can get it in Sierra charts. There's a couple of other platforms. I think ATAS does it. I think Quant Tower does it. Surely there's something like that for what's the one with the pretty charts? Anyways, okay, so it's not the only game in town. Right, the biggest feature has been duplicated by a lot of people. Okay, but I find two things is that number one, just like the little features, you know, there's little features that Jigsaw has that I just don't see on other platforms. Like a really good example of if I come in here into the settings is like they have these trading things where it's like, okay, close outstanding orders when a position is closed. So if I'm like, you know, clicking in here and I miss it and then I get in, I don't want my other order still sitting there, right? It just kills it for me. It's so useful, right? like Jigsaw understands trading, like because Peter actually does it, right? They understand the trading and how to build a cohesive system that actually works for the trader in a way that other developers don't. Like Sierra Charts is just a smorgasbord of, we took all of the features that everybody else was doing and we don't even necessarily understand why they have them or what they're doing, and we're just going to put, cram it all in there, and they do it in a way that doesn't make sense, and they don't always have all of the tiny little things that really make it optimal for you, right? So that's where it kind of comes into more of a difference of quality, right? So I would say that there are a number of platforms out there that will get the job done, that has the information displayed on the DOM in the right place for you to be able to read order flow and so forth, right? But nobody does it quite as well as Jigsaw, and Jigsaw continues to put out new features that are useful that other people don't have. So that's the difference. Now, here's another thing that I would say that I don't think a lot of people factor in when they're looking at what platform to buy. Okay, because one of the things is Jigsaw has like a $50 a month platform fee for you to put live orders in. If you want to just trade sim, doesn't matter. But if you want to put live orders in, you have to pay $50 a month or something like that. Okay, it's a lot, and a lot of people are like, oh, I don't want to pay that. Okay, but Sierra Charts also does that. It's just like, it's not as much in your face about it, right? So it's not until you get into the platform and everything and you look at it and it's kind of all combined with your platform fees and everything. It's a little bit cheaper than Jigsaw, but not by a whole lot. It's like a $10 difference or something like that on the monthly fee, right? So if you kind of say most of these platforms have a monthly fee, then the real difference with Jigsaw is the one-time upfront cost, right? And so that's where, I really think that you're getting the value, right? I bought the Jigsaw, like, seriously, it's been like 7 years now or something like that, Yeah, it was $500 at the beginning, but I don't ever think about that anymore. It was more than worth it. Exo Charts, I've never heard of that one. Never heard of that one. Like the Ammo Fatty likes the book maps. I gotta tell you, the book map chart sort of things, the liquidity heat maps, I'm not really a big fan of them, especially not for trading in the treasuries. They do not replace what I can see on the DOM. Like in particular, this whole thing about every time that we lift price, how many orders does it take? Okay, we take 1,000 contracts, we go up, then it sits there for a while, it comes back down. Okay, next time we go, how many contracts does it take? And, because we might be there for like 5 minutes, and it might do that like 20 times, but like how many contracts was it doing each time that it did that? You can't see that on Bookmap. You can see that on the DOM. So it's not a replacement for the DOM. And I find that what it does is it kind of focuses your attention on where are there aberrations in the liquidity? Is there a price where there's more liquidity or not? And you'll tend to see this thing where when price folds back on itself, you'll tend to see some liquidity gets left behind down here, right? Like if we did reverse back up, I almost guarantee you that there would be a relatively large order at the low, right? And you're going to see that on the book map, and then you're going to say, oh, every time that I see one of those, price bounces, so that's my signal, I'm going to take it. So I kind of feel like that book map leads you towards a strategy that's not really very effective. Doesn't mean that those charts are hard, it's not the full picture. If you're going to trade treasuries, you really need to have a DOM up, I think. And I guess the other thing that you really got to keep in mind here is you got to assume that anything that you're looking at here is unproven, until you've proven it empirically in some way. Okay. And you can't just come in here and trade a signal for 2 weeks. I used to think, oh, I can just do it for 2 weeks and see how it works out. That was before I really understood the statistics and the math about it, right? We are, as humans, are not capable of seeing enough data at one time to make conclusions on strategies. And you often, especially in the high frequency world, I know that we're not doing high frequency trading, but we kind of have to think like we're in high frequency trading, really, right? Especially from a statistical point of view, you're going to want thousands, if not tens of thousands of trades to verify a strategy, right? Which in order flow, we usually just don't have that data or capability, right? So if there's some feature or thing that a platform puts out, everybody assumes, oh, well, they put it out there because somebody found it useful or whatever. You still got to say it's questionable until proven, right? Some of the indicators that I include in my indicator suite, some of those I created because they are trying to find those stylized behaviors of markets or are based on the models that I've read about in studies, okay? But some of them are, here is data that I can see and a way of organizing that data that other people haven't thought of yet that looks interesting to me. I can't prove anything with it. I'm not sophisticated to do that, but I'm giving you the tool because you might be able to, right? But that's my kind of, but until, you're able to actually prove something with it, it's still unproven. And you got to look at it like that for every new feature that comes in. Because what happens is everybody says, oh, I want to go and find the thing with the most toys. That's Bookmap, right? But I'm just saying, none of that stuff is actually proven, Especially these ideas about like, the market always goes towards liquidity or it always moves away from liquidity, and those sorts of things are kind of like, doesn't really actually work like that as far as I understand. Can you explain in a few sentences the best way to start DOM trading? So I think that the next video that I need to make is going to be this. So how do you start trading? Because a lot of us think of trading as like a process, like cooking. I'm going to give you a cooking recipe and then you just follow the cooking recipe and then you can trade. It doesn't really work like that. You have to approach trading more like learning to play a sport. I think learning to play a sport is a really great example because playing a sport is competitive and you're competing against other people. Whatever it is that you do, other players are trying to anticipate and prevent you from doing, right? So when you're learning a sport, you kind of have to take a very different approach to it, right? So how do you learn to play basketball? Well, you're going to start with fundamentals, right? You're going to learn to dribble the ball. You're going to learn to shoot. Then you're going to do drills against other players. There's things like that, right? And what are you doing as you do that? You are building a model in your mind, just like a machine learning model does. You're building a model in your mind about how to play this game, and your brain is making new brain cell connections and maybe even new brain cells. I don't know exactly, we don't understand completely how it works, but it's building that network out, right? But the way that you have to do that is you have to start with some good foundational principles, and then you practice on top of it. And as you play, you're compiling all of that information into your model, right? So that's how you have to approach learning trading. So I have a set of videos on my channel that's like my order flow series. You watch those 6 videos. That is kind of like your foundation. Okay. I have a bunch of other videos that are kind of more like general trader tips or like setting up your platform, that sort of stuff. Okay, right? But the foundation is that order flow video series. So you watch that order flow video series, and that tells you, what we really know about the market. Okay. From there, you're going to come in every day and watch it, right? So like watching those videos, that's like your basic instruction, how to dribble, how to shoot the ball, etc., etc. Then you have to come in and you have to actually play the game. And that means read analyst reports, understand what's going on in the market, what people are thinking about, what is the state of the economy, etc. Listen to the breaking news, the economic reports, watch the order flow and see how the market reacts to every new piece of information that comes in. And as you do that, your brain is going to make those connections and it builds that neural network. And at some point, it gets to the point where you don't even understand how it's coming to the conclusions that it does, because we just don't understand those networks. Like, it's beyond our understanding. But you're building like a living network in your brain, right? That's how you have to approach it. Seth explaining something in a few sentences. Yeah, that was like a big essay. I basically gave you a big long answer, but the simple answer would be go watch my order flow video series. If you go to the page, the channel front page or whatever, you'll see it there. Okay, can you say something about VWAP and standard deviations and that the price always returns to the VWAP? Yeah, okay, so early on, I did a lot of study about this and back tested a couple of these like kind of setups. And what I have seen basically is that there are some behaviors in the markets that are relatively consistent with VWAP. So when people say they love to trade VWAP and they think that it's really important, they're not like getting that out of nowhere. It is. But my backtesting suggests that it's not actually an edge from a risk-adjusted basis. So what you will see, for instance, well, we're at the regular session VWAP right now at 112, but when you come back to the VWAP, pretty decent probability that we will bounce. Pretty decent probability that we will bounce, but there's more money when it doesn't bounce. There's actually more money made when it doesn't bounce, right? So it is the first thing that you got to realize is like, if you go and you do a probability on something, right? And it says that this thing happens like 60% of the time or something like that. What that means is when it doesn't happen, there's a lot more money available from it, right? That's how the market like it gets back to efficient or statistically efficient, right? Is it has to do it through the fat tails. So then we can go into like the actual VWAP itself. Okay, so why is the VWAP important? Well, the markets are very sensitive to new orders. So if I wanted to come in and buy 50,000 contracts of treasuries, how am I going to do that? Because I can't, I'll move it too far. I'll move the market too far if I just do one big market order, right? So what do I have to do? I have to split it up and execute it over time, okay? How do you do that so that you minimize your impact on the markets? Well, one of the ways that they would do it is with a VWAP algorithm. So they would say, if I want to buy and we're below the VWAP, then I can just buy it. And then if we're above the VWAP, I can wait for it to come down, and then if it's been too long, then I'll just buy it. And that was like the best that they had for execution on the VWAP. The problem is that traders picked up on it and started to take advantage of it. So now all of a sudden, if they know that somebody's buying it, they would start to screw with it and push the market against whatever that guy was doing and really mess them up. And so you would start to see in the 80s and 90s a lot of these institutional traders complain about the market, screwing with them on this. And then in 2000, essentially, a study came out by Almgren and Chris called Optimal Execution of Large Portfolio Transactions. And this algorithm basically said, do all of the optimal, frontier sort of stuff that you do when you're compiling like an optimal portfolio. But do that on the instrument that you're trying to trade, and determine how much you're going to trade, and then this algorithm creates like an optimal schedule for it. It basically says, based on the current liquidity conditions that you have, here's the amount that you can trade that will optimize your impact on the market. And the way that it tends to do it is they will trade until it starts to have an impact on the market. Once that impact is apparent, the algorithm will back off. So this explains why it's like, the market's moving up, and you're like, oh, now I'm really certain that like this is going to trend up and I want to get in, right? And then as soon as you do that, it stops doing it, right? That's why. It's just because of Almgren and Chris. They're very good at, as soon as the impact starts to be felt by the market, they pull back. They're still executing, but much more slowly, and they can actually execute a lot in that area. Because it'll sit there for like 45 minutes and they've just got a slow trickle of orders. You actually end up getting more filled in that area than you do when you were pushing it up. And then when the liquidity has balanced back out, they do it again. Right? So what does that have to do with VWAP? What I'm basically saying is VWAP is the old way. VWAP is already outdated by almost 20 years now. Almost 20. It's been a long time. Okay. So, there's a lot of people that they've based their trading almost entirely on technical setups related to VWAP. I wouldn't recommend that. There's something to it, but be very careful about this idea that like it effectively predicts the future with some sort of probability. It's not one that's in your favor. I just blew my nose there, and that was one of the most satisfying nose blowings I've had all week. That felt so good. Eurobond can find a balance here? Question mark. It looks like so. It looks like there's a bit of a hole at 112 even. So you get this thing, like, right? Like, we're moving up, and then all of a sudden, like, what? It gets stuck in a one tick range for like 10 minutes. How the heck does that happen? Well, that's the liquidity hole. Basically, nobody's willing to put the liquidity up at 112 even. There's a little bit of liquidity here. There's a little bit of liquidity here. So anytime that they try and push through this liquidity here, there's no liquidity below them, and so they just fall back into it. And vice versa on this side. There's no liquidity above them, so they just fall back into it. So you get stuck at 112, right? Now, if I come back over here and I look at it, am I seeing that right now? Well, what am I seeing in the middle there? There's 713 offered. That's normal. 1832. So they did take a relatively aggressive take from down there, right? So what I'm kind of seeing is maybe there's a little bit of a liquidity hole, but it actually kind of looks to me like there's just not a ton of interest in the market at the moment. So maybe that little push out there can kind of shift things around and it attracts more selling. Otherwise, they're likely to come back to that 112. But there is, you could call it balance, right? They basically, the way that I would think of it is price tends to settle where supply and demand are at their minimum, essentially. So your typical like volume profile auction theory trader, they think the opposite, right? They think a lot of trade happened there, a lot of people are interested in it, that means that it's an important price because it's balanced. But then it's like, why do people trade if they think the price is fair, if they think that it's balanced? They don't do that, right? The reason that a lot of people trade there is because there's a liquidity hole and it just keeps it there for a long time. And these guys, they're executing buying, selling for whatever reason. I don't know if I see super strong evidence of a large meta order, but I think that if you force me to make a trade here, I would still be favoring a long. It still looks slightly in favor of the longs in the treasuries at the moment. You would never know it. This is, I love this sort of thing. You would never know when you look at it from like a price action technical analysis perspective, right? You're going to say, oh, well, we're stuck in a range. This doesn't tell you anything, right? But look at the cumulative delta, right? Pretty consistent long. So somebody's buying very gently within there. Is it enough of an imbalance for them to break out and move up here and really make it worth us taking the risk on it? I don't know. I'm not sure enough on that to place a bet. But it is something that we can see that a lot of people don't see. I was going to ask you to go on a politics rant, but then you guys have some good trading questions, maybe later, question mark. Some last words about delta and imbalances. Okay, so cumulative delta is the best indication that we get of informed trading, right? So this whole idea, there are some ideas about technical analysis that are just wrong, right? Like their whole idea is people are consistent, and so you see these patterns in the markets over and over again, except it's not true. People are very, very resilient and flexible and adjust to the market very quickly and easily. But one thing that they say that is correct, though, is that you can look at market data and potentially glean some things about what like certain insiders are thinking or whatever. Because when people come in and make trades, it is going to have an impact on things. Now, the big mistake that technical analysis makes is they're only looking at price, because market makers intentionally inject some randomness into their price. That's why you'll see this sort of thing where we've been going back and forth in a range, but then when you look at the market orders, the cumulative delta imbalance, you can very clearly see that they're buying it, right? So there's an imbalance that technical analysis readers can't see. Okay, but that imbalance in cumulative delta, that's the best indication that we have of potentially informed trading. Now, not every change in cumulative delta is informed trading, and that's where the rub is, right? Is that the market is not informationally efficient. So what they'll tell you is, okay, yeah, like somebody comes in and trades it, but if it's not in line with the fundamentals, then the market will revert back down very, very quickly and whatnot, right? But it doesn't actually work that way. If you move the market, you push it up here, right? And then it'll come back just a tiny little bit. When you take your finger off of it, it'll come back just a tiny little bit, and then it'll just stay there. So the impact is permanent. And that's regardless of whether or not there's informational content behind it or not. So while that change in cumulative delta is the best indication that we have of potential informed trading, it's not guaranteed, right? And so how do we deal with that? Well, the way that we deal with that is we need to be informed ourselves, right? If I know things about the way that these hedge fund strategies work and everything, and the way that they are likely to be positioning themselves today because of that, and I can anticipate that ahead of time, then when I start to see that imbalance, I can say, that's that hedge fund that I'm looking for, and I can take the trade with more confidence. And that's how I approach it. You're completely shattering everything I've learned so far. I'm studying market profile for a month now, and you're saying the exact opposite. I'm glad that you see it that way, because I think a lot of people, that when they hear me talk about it, it doesn't necessarily click in there, like how big of a paradigm shift it is, you know? But I don't come up with this shit. I don't. I tell you what, I think that the funniest, craziest thing in trading of the last 5 years or so has been these smart money concept guys coming in and saying that they've invented this new style of trading that takes into, understands the algorithm that runs the markets, and the FBI came and told them to stop trading it, but they kept doing it, and all of this sort. It's just absolutely bonkers, because all they're doing is rebranding failed strategies of the past and marketing it really well on YouTube, and that's all they've done, right? They and they think that it's all them, right? Versus me, what do I do? I'm not this genius. Like, I'm pretty smart. Not gonna, like, I think highly of myself, okay? People tell me that I'm smart, but I'm not that smart. I'm not smart enough to come up with this shit. These are people that are study math their entire lives, and they just come up with the most brilliant stuff that I would never in a million years figure out on my own, and they were kind enough to write studies and publish them in peer-reviewed journals, and that's where I'm getting this stuff from. All I'm doing, the innovation that I've given you, is I'm able to take the information that they have and translate it into how it's relevant to you as a day trader. That's all I'm doing. Do you know how to anticipate range or trend with order flow? Yes. So the amount that the market will move is a function of what? Well, there's a formula for it, right? You've seen this formula before, Amir, right? We talk about it all the time. The change in price is equal to Y, which is a scalar between like 0 and 2. 0 less than, I don't think it's less than or equal to, less than Y less than or equal to 2. Okay, it's a scalar that's different for every instrument, but is consistent. Like the Y for ZN will still be pretty similar Y a year from now. Okay, Y times the volatility times the square root of Q, which is the size of the order that we're expecting, over V, the amount of volume for the time period. So I can go and I can look at what is the average volume for bars, what is the average volatility, and how many orders am I expecting, and use that to come up with a pretty accurate estimate of how far the market will move. Now, I would not expect you to go in and like try and plug in this formula every time that a move happens and to try and figure out how far it's going to go. That would be kind of silly. But the key thing here is, what's that Q, right? So if I get a move, if I'm anticipating a move, I'm anticipating a certain amount of Q. I come in and I say, based on my experience and the significance of the signal that or the imbalance that I'm seeing, I expect there to be a 15K change in cumulative delta, right? And then I get in and I just wait for 15,000 contracts to trade. And then the market gets stuck in a liquidity hole and I get out. That's how I use that. Yeah, the Dewey says I got scammed by a VSA guy in that lesson. VSA guy, is that a volume spread analysis? Yeah, I've seen that thing before, and everybody like talked really highly of it. And I don't remember what it was, but I went and read a book about it, and I was like, this is dumb. Okay. How did you learn about macroeconomics, like the impact of interest rates, CPI, unemployment rate, specifically in the trading context? I really wish that there was like a single source that I learned all this stuff from, and there's this book and I just give it to you and like you learn all macroeconomics or stuff, right? I think that one of the biggest places that I learned it was watching CNBC every day. When I started doing this back in 2008, like I got involved when the financial crisis happened, right? And all of a sudden I was just obsessed with it. So I pretty much at that point just like pivoted my whole life towards finance at that point. Because before that I thought I was going to make video games. And at the time I was doing Thinkorswim, right? Thinkorswim was an amazing platform and it had a decent sim platform. So I was just using Thinkorswim, and within Thinkorswim, they gave you free access to CNBC. So I literally just sat and watched CNBC all day while I was working at my job. And especially like Fast Money and Mad Money at night. Don't follow Jim Cramer's like recommendations, but listen to what he says and the reasoning behind it. You learn so much about the market from it, man. Just doing that every day for, probably 3 years. I think that was a really big one. And then since then, I read Zero Hedge every day. I read CNBC every day. I'm just reading a lot of content about the economics and stuff, right? Another one is I read the economic reports. Right? I understand what's in those reports and what those numbers actually mean. I read analyst reports where they dive into those numbers and explain those sorts of things. So that's a lot of it. Okay. Another place that I learned a lot, and I think that in this case it was like stuff that I already knew, but I think it really cemented it in my mind, was doing the FINRA tests. So like studying to get my Series 65. There's a lot of macroeconomics sort of stuff around that. Studying for futures, the Series 3. There's a lot of macroeconomics about that. I've learned a lot of that. But then it comes back to this whole thing about how do you learn how to trade? You have to read all of that stuff and then come in every day and watch the market and see how the market reacts to that. And that's how your brain kind of makes those connections to understand what's going on. Do you pay attention to volume nodes, high-low volume nodes? Yes and no. So when I'm seeing a liquidity hole, like remember we were talking about that there was a hole at 112 even. There appears that there may be one here at 30 as well. Okay. You will see that there are kind of jumps in the volume node at those spots. Okay. But I want to be able to tell that there's a liquidity hole before it becomes the node on the volume profile. Okay. And I have to keep in mind, so like this 112 still matters. We were there only 10-20 minutes ago. Okay. And it takes about 45 minutes for that sort of stuff to heal. So it's entirely possible that we could slip back up to 112 even. That's still a factor right now. Okay. Once it's been 45 minutes, I don't care about it anymore. Like, a lot of people do this stuff where it's like, where were the high volume, low volume nodes in the previous day? And they try and make trades based off of that. Yeah, doesn't matter anymore. Once it's been 45 minutes, it doesn't matter. So that's why I say yes and no. Because there is something to it, but it's kind of the problem is you're looking at the result and not predicting something. By the time you see it, it's maybe not so useful to you, right? Like now we've seen it. What does it tell you? It tells you that the market is stuck between these two prices and that it will take more market volume than usual to bust out of that range. So does that give you a trade? No, it kind of tells you maybe don't mess with it, right? So by the time you see it, it's not as useful. At least in terms of, you know, making a trade. It's useful in terms of not making a trade. It's good. There, you guys are right. There's been a lot of good questions this morning. I don't really know if I have any good political rants to go on this morning anyways. No, I do. You want to hear my rant? I'm going to blow my nose first. Ugh. I got a lot of stuff out there. Oh my gosh. I need to delete half of my indicators. Well, that just makes me want to go on a rant about technical analysis because, you know, they're not with most things in trading, they're not like pulling stuff out of thin air, but the understanding that we get as retail traders is usually super flawed, right? Like we talk about momentum. Well, okay, momentum is a daily, weekly, monthly phenomenon that you can see in a large portfolio of managed futures. It's not something that you run on a single instrument on an intraday time frame, right? Chronic corona, it could be. I do wonder if I have COVID or if with something else. The amount of snot that I produced in the last week is probably more than I've ever had. It's not congested. It's coming out pretty easily. I don't feel that bad about it, but it's a lot. And I haven't been working out recently or anything because it's just like I kind of felt like that when I pushed myself too hard in the working out, it was kind of helped make me sick. So and we're getting some news here. Is this the PMI? Is the service S&P services PMI? Okay. So slightly higher than anticipated, 51.4 versus an expected 51.3. I'm not seeing a lot of I'm not seeing really any orders come in off of that. The liquidity is returning. Maybe that one's going to be dud. I mean, it was slightly higher than expected, so that could continue the move down, but it's not really going, so I don't think I want to make any moves off of that. Still got some stuff in here. I'm gonna try blowing my nose one more time. Okay, so here's my rant. Am I the only one that feels like YouTube is turning to crap? What do they call this? The enshittification of the web. Everything on YouTube is crappy clickbait now. I hate it. I just hate it. Like, I'll still get stuff about like music production, but like every video that I see, it's stuff that I already know. They like way overpromise and underdeliver. It's just, you know, and then the rest of the content that it tries to recommend to you is like Mr. Beast kind of content, even though I don't ever watch that kind of crap. But it thinks that I'm gonna want to watch that. Doesn't show me as much of the creators that I want to see or that I like watching. It's not as good. And there's been like a noticeable decline just within the past year. And it's driving me crazy. It's like the YouTube algorithm just doesn't push the quality content. It doesn't. It pushes the like lowest common denominator. And it sucks. Yeah, the area that you call liquidity hole is accumulation or distribution. Of course, everyone says something. Well, you know, accumulation or distribution would be a term that I would be okay with, right? I call it a liquidity hole because I'm trying to stress to you what's causing it. What causes it? It's not that somebody thinks there's something important about that specific price. It's just a random aberration that gets caused by the way liquidity works. There's nothing special about that price other than that that's just where it happened to happen, and all of the volume went through there. That's the only thing that's important about it, right? That's why I don't like, you know, the word balance and stuff, like, because all of these other theories are basically saying that price is important because everybody that must mean something. Because everybody wanted to trade there, that must mean something about the market. The market thinks that's a fair price. The market thinks that's a good price to trade it at. And that's not what it means at all. It just means the latent liquidity was low there, so it couldn't get out of that spot. That's all it means. And you'll see, like, you know, we moved a little bit down off of that news, but you can still kind of see that it having a tendency to move back towards that hole. Wasn't a whole lot that sold on that, so I'm a little bit... I don't know if I could buy it right now, but it still kind of looks like if they're going to continue to move down, it's going to be a super slow one, right? Let's see here. Oh, I want to try something here real quick. Or market profile daily values. So I made a video about that the other, like, my most recent video, was it? So I think it was my most recent video where I backtested some of those setups and showed that they weren't really all that special. Oh, maybe he's doing this. Hold on. I had an idea about trying to do something for somebody and is like not working. And okay. So what was I talking about? Oh yeah, the volume profile. Yeah, so let me go deeper into the volume profile thing, right? So again, like the point of control right now is 31.5. Is there anything special about that price? It's right next to that 112 even. That's probably why it happened. It is a liquidity hole. So it's trading there. There are these guys out there. They need to buy 50,000 contracts or whatever the deal is because they are sovereign wealth fund and they got to get rid of what they've got. Or maybe they are they're issuing corporate bonds and they want to hedge themselves against a change in interest rate before, while they're waiting to issue the bonds, right? So they're going to buy or sell a certain amount of treasuries and they're executing it wherever the price is. They don't really care where the price is. They need the current price. They're trying to minimize their impact on the market, but it's more than the liquidity can take. So sometimes they exhaust the liquidity and it creates these holes, and that's it. And it was nothing special about the price to them that they did that there. So to come in and then say tomorrow this price is super important, probably not. Now you will see some statistical aberrations from that. For instance, because of the stylized behavior of volatility, where volatility tends to cluster and so forth, the previous day's point of control is extremely likely to trade. Probably 60-70% of the time, you will touch the previous day's point of control. But is that a good trade? If you were to say, if we are below the previous day's point of control, buy it on the premise that it goes up to it and vice versa on the other way, right? And you try and hold it all day. Is that a winning trade? No, it is not. It's not, because the amount of risk that you have to take is bad. And when you lose, when it doesn't go to the VWAP, it's going to go really far away. Right? And if you try to say, oh, well, the VWAP is 8 ticks away, so I can say my target is 8 ticks and my stop is 8 ticks, you're just as likely to hit that stop. Just as likely to hit that stop. So what does that tell you? The reason that stat exists is because of volatility and not because the price is special in some way because it traded so much. So be very careful with those setups. I have a suite out there. I post it's in the downloads channel of our Discord. It's also up on Futures.io. That is like a stats suite, and it shows you some of those stats so you can see them. And in particular, it graphs them, so you can like put it on a daily chart and graph it for like the last 5 years, and you can see how those stats change. And once you see it craft out and everything, I think you might think twice about premising your entire strategy on one of those statistics. Are you going to come back to 112? It kind of looks like they might be able to pull it out. So this rant, yeah, I thought you guys are all going to be like, yeah, YouTube sucks. Why am I on YouTube right now? But maybe it was y'all just got so fed up with it. Yeah, you know what, Seth? You're right. I'm not going to watch this anymore. Think to rent a VPS server near Chicago because my connection here in Germany is, yeah, well, so there's Speedy servers. Is the only one that I know of. Yeah, if you're in Germany, that might, and you wanted to trade on the CME, that might be hard. But if you're in Germany, why wouldn't you trade on the Eurex, right? Why not trade the Bund and the European indexes? Bund is a pretty good instrument. If I was in Europe, I would probably trade the Bund. Jiwi says, I'm in Croatia and I trade US Treasuries, no connection issues. Well, you are going to have latency. But for sure, if you're trading ZN, it's slow enough that the overseas latency probably isn't going to matter a whole lot. I feel like I'm just like leaking from every orifice of my body here with the freaking cold, man. Or at least from my head. Good grief. Britney Spears says she will, quote, never return to the music industry. You know, there was this article the other day where Trent Reznor of Nine Inch Nails said that he has no interest in doing any music industry stuff. And he said that, like, the music has been commoditized, that you don't really make a whole lot of money from making the music because what you get paid for on the streaming is just like ridiculous compared to when you did the album sales, right? And you know, a lot of people were like, well, I don't really want to pay more for music or anything. And also a lot of people focused on that. And I felt like that was completely the wrong take. Like, there is still tons of money in the music industry, right? Like, Taylor Swift single-handedly held up the US economy in quarters 3 and 4 because of her music tour, apparently. Like, her music tour had a measurable economic impact everywhere that she went, right? And these streaming services, they have made money, have made tons of money. There's still tons of money in the music industry, okay? So this idea that it's like there's no money and people have to pay more to get, it's ridiculous. No, the problem is none of the money is going to artists. It's all going to these labels and leeches, basically, that frankly, I don't think really give you your values worth. I can't tell you how many times I've spoken to friends. You know, they get a deal with a label, they get published, and, you know, the whole thing is the label's supposed to promote your music, and they didn't do jack squat. You know? It's stupid. It's just Absolutely stupid. Where the money is going, right? So when that happens, if you're not really getting paid fairly, people are going to tend to pull back. So it doesn't surprise me at all. Trent Reznor doesn't want to make music. Britney Spears doesn't want to make music. Dude, the world, the industry sucked her dry, man. Britney Spears, it's sad. You watched that documentary about her? That was disturbing. How she was taken advantage of. She straight up was. I mean, she's got her problems. She does, but she was abused. It's sad to see. You know, Taylor Swift too, to some extent. I mean, I know that what I see and our impression of people and celebrities is not real. You know, like if I met Taylor Swift in real life, I would have to completely forget any predispositions about them and learn what they are as a real person, because what we see is not reality, right? But there's a lot of drama around Taylor Swift. Maybe some of it is that she made bad choices, or maybe she's a little narcissistic. I don't know. But then there's a lot of other things that I see where it looks like she was, you know, a kid that didn't really know what was going on, and she was abused. And here you're talking about like the top person that's like a billionaire now. And she was very abused by the system, though. Like the emotional toll. Oh my gosh. I'm sure did a number on her. That Britney Spears made money on concerts, not on streaming. Yeah, and they worked her to the bone too. It was like because her dad wanted the money. That's why Vanilla Ice preferred to flip houses instead. Yeah, we've got a real problem with the art industry in general, because the internet enabled artists in a way that they've never been enabled before, and yet at the same time, the internet also created a power imbalance that I think has really created a distorted market. I don't think that the price that you get for streaming your music on Spotify is a fair market price. You know, I don't think the price that you get for streaming stuff on YouTube is necessarily a fair market price. But it is a fair market price because it's hard to run a streaming platform, and who's going to do it for you, right? But they're taking way more than you would in any normal circumstance. And it's so much that it becomes prohibitive that a lot of people that would otherwise do it can't do it. I make music. I would never try and make a living from it. No way. Of course, there are some things like, you know, if music was a really good standard way to make money, you know, then everybody would do it, because, you know, a lot of people like to make music, right? So that's one of the things where there's always going to be an overabundance of supply. Not AI is changing fashion. Some company created an AI model because they didn't want to deal with moody women. Well, but I got to tell you, I think the thing that happens is at first the algorithms will have some novelty and are able to single in on something that really drives engagement, and then people get tired of it very quickly. And I think that the thing that I see in machine learning is that the goal is really critical, right? You have to give the algorithm a goal that it's trying to optimize towards. And it will just optimize that one thing. And so if all you care about is engagement, then it's going to optimize towards engagement at the expense of literally everything else. And there's a certain point at which, you know, that will actually harm engagement. And I think you're starting to see it happen. Oh, now AI is changing fashion. Good. So you'll see that where it's like, yeah, people will make, things like even porn off of AIs. And it'll be because I tell you what, I've seen some pretty hot AI generated faces. Oh my gosh. But they're bland. It's like once you've seen it a few times and then it becomes dull and boring. There's no novelty in it. There's no personality to it. You can tell that it's just a copy of something, that it's, and you're seeing it everywhere. Every corner of the web. I really feel, I think this is maybe one of the things that has kind of started to drive me a little bit more towards we might be going into a recession. Because this is something that I kind of remember seeing in 2008 was kind of this feeling that everything was getting stale, It's easier to create a new AI face than to hire an yes, it is. Well, the fact that these AI influencers is a thing is like really wild to me. Is that why I need to make a new AI influencer to influence trading? Can take videos of me and just replace it with a really, really good looking girl. Redo all of my videos with a female. See if it, a hot female and see how that helps the engagement. Could do it. But like another way of thinking of it is that it's created like the floor is up here now, right? Like it's so easy to generate trash content that is just everywhere. It's all you see. Well, so like, but with the way that it works right now, mostly what you're doing is like, you can take one video and then superimpose the look of something else on top of it, right? So what I could do is I could make a video of me doing a dance, right? And then have the AI model create a new female face and then have it recreate that video with that female instead of me doing those same movements, right? That's how that stuff works. But I think that there's this idea that like art won't be worth anything anymore because everybody can just use AI. And I don't think that that's going to be the case. I think it's just going to make good artists more valuable in the long run. But in the short term, it's the enshittification of everything and it drives me crazy. I'm bored of it. It discourages people from doing that, then is a good thing. Maybe. I don't know if it actually would do that. I mean, there's this bigger thing, which is like, you get a real rush from the praise of others online. It's like a crazy supernatural thing that our biology was never designed to handle. And it's driving us all crazy. It's only when we get to the millennials like myself that are getting close to their 40s that it's now exhausted them, right? And now I sit, in the evening. There's been some times where it's, it'll go in cycles. I'll sit down and like, oh my gosh, everything that I see on TikTok is great. This is so funny. This new person, I love, this was good new information. And all of these influencers, they're so good looking. But then I get on it or like now and it's like it's just the same old stupid crap. This is so dumb. Yeah. I'm over it. Been doing more reading this week than anything else because the internet is boring me. I'm bored of the internet right now, man. Okay, so we still haven't traded that 112, but it's awfully close. It has been long enough that I don't know if that price is that important anymore, other than that it's a really round number, so. S&P 500 is looking okay, though. Is anything else doing anything interesting? Well, natural gas is moving 3.2%. UB is the biggest loser today, 1%. This is a noticeable decline in the treasuries. But not during our session. It's been pretty tame, our session. If I had taken any trades today, I'd be super frustrated, right? So I think my read of it has been pretty darn good so far. Which is a little disappointing because I was kind of hoping after having such a crazy day yesterday that I could come in and just take a solid trade and get something and kind of get myself back on track. But I guess I'll have to wait maybe until next week because tomorrow's going to be just like bonkers. It's going to be bonkers. Oh, geez. So I'm kind of like browsing Reddit a little bit to see, you know, there are new stories coming out this morning or anything like that. But everything's talking about the Jeffrey Epstein list that came out, which I looked at and I didn't see any new stuff in it. So, like, there you go. Now 112 even finally goes bid. Well, so I could have tried buying it down in here, but like, come on, $10. That's like a lot of work for $10, right? Bitcoin is seeing a little bit of a run here. Cool. Starting to get tax statement stuff. That makes me excited. Hmm. Well, what do we think from here? I don't know if the treasuries are going to do anything interesting before we leave here today. We get like, oh, there is a 4-week bill auction. Oh, the spot ETF, the spot Bitcoin ETF decisions is tentative, so that might, my news squawk is suggesting that that could happen today, but maybe, but after market. So that's curious. I know that you hate TA, but what about Fibbo levels? Oh, geez, yeah. So, you know, I think that levels, quote unquote, is like probably the area where there's like there's going to be some innovation out there that is like, how do we judge the effectiveness of a line? You say this fib level is important. Okay. Is it important because we tend to bounce off of it? Because we tend to move towards it? Like, and like how predictive is it? And how precise is it? And there's all of these different factors. And now how do you combine that together into a score to say, this line is better than this line? To be able to prove that what you're seeing at that line is not just random, you know? I don't know how to sort that out. I don't know if anybody's done that. But every time that I've tried like backtesting something off of it is, you know, I haven't found anything. The one thing that I will say is that there is a square root and a 3/5 law, right? So remember earlier, we did this this equation. The change in price is equal to y times the volatility times the square root of Q over V. So when you graph that out, it looks like this, right? Because think about it. If Q was like 0.1, if Q equaled 0.01 V, okay, what is the square root of 0.01? It's 0.1. Okay, what is the square root of 0.02? It's 0.141. It's, you know, it's an irrational number. Okay, so it looks like this. There's like an upper limit essentially. So you'll see that on charts. You'll see a move. It'll go like this, and it'll kind of like start to trail off, and like it can't go any further, right? And then what will often happen after that is the meta order will stop, right? Like the meta order that was pushing this off, it stops or it pulls back, and what you should see happen is a post meta order regime change period. Okay, and this follows a 3/5 law, which is to say that it follows y omega times Q over V to the 3/5. Okay. So when you game that out, it does it both in price and in time. So basically what you're going to get is that this is going to be 2.5 times this. This is 3/5. Sorry, not 3/5. Sorry. It's so if you say it's 2.5. Yeah, it is 2.5. Because if you do the 3/5, 1 minus 3/5 is 2/5, and then it's like the inverse of that. It's 5/2, which is 2.5. I don't remember exactly how I got to that conclusion, but it's 2.5 times. So usually this is 2.5 times this. And the amount of the decline, you know, you can kind of calculate that on each move and everything, but it tends to come between that 50% and that 3, whatever the Fibonacci number is on there. So that might be why people seem to think that the Fibonacci number means something. But I mean, that's the interesting thing, is that if I'm executing a meta order and I'm the one executing it, I can predict how far it's going to come back after executing it. Right? That's kind of cool. Only if I'm executing the order and I know. But so maybe that's where it comes from, but I don't have any evidence to suggest that Fibonacci levels themselves are anything more than random. Just where I come back to, how do you judge the effect? How do you come in and say, okay, here's a line, and here is some data that tells you that what you're seeing at the line is not just random? How would you even go about proving something like that? I don't know. Get a blow a dose. Let's see here. BS says you'd be trying to quantify trader superstition. Well, yeah. It's kind of funny the way that this all works, because like people think that they're logical and they're not, you know. I was having this argument with somebody the other day, and they were, I was like, okay, so you're saying all this stuff, but like, can you prove it and like use an intraday time period? And they were like, well, why does it matter that it's an intraday time period? And so then I had to go into all this stuff that's like, well, so we know that like momentum works on like daily, weekly, monthly time periods, and that kind of uses technical analysis, but kind of the way that we understand it, we're not even sure if the technical analysis is what actually provides the edge, because you have to do it over a large portfolio and all of this sort of stuff, right? So, and then on top of that, if I'm going to do it on like daily bars, now I have to factor in the risk for holding it for days on end. So now I can't just say, is it profitable? I have to say, how does the strategy perform on a risk adjusted basis compared to the alternatives, right? Whereas on an intraday basis, it's not really a factor. So I can just kind of say, okay, like this thing with a given risk reward, what's the probability of it coming out? And it's really easy to test, right? They were kind of trying to say that like, well, because this one thing works, that means that technical analysis works. And this is no, that means that PSM and CSM momentum works. That doesn't tell you anything about any other technical analysis setups, right? This is a logical fallacy that people will fall into really, really easily. And like, I can see it, but it's like, I can see it because I already know all of the, everything about it, but I'm also just an unusually logical person because of the medication I'm on. So like, when I see those sorts of things, it just exacerbates me. So yeah, BS is right. Like, why should we go and spend all of this time trying to quantify every possible trader superstition that's out there about levels and this does this and this does that? It's pointless. Like, and I need to have like, if I'm going to do empirical research, how do you determine what the research that you're going to do is, right? You have to have some kind of filter to tell you that like, this thing isn't really worth investigating because it's unlikely to yield anything compared to this thing, right? So I don't know, but I do think that if you were able to quantify the effectiveness of a line, you could do some research on it. It's just like, then the research would probably be like, it's random. I think that you would see like it's random, and that round numbers tend to see a lot of activity around them. And moving average, like 50, 100, 200 day moving averages have a lot of activity around them. And the rest, and another one would be like previous days highs and lows. Or like major highs and lows from week, month periods. Those probably matter because those can often be triggers for momentum strategies. But that'll just be like activity will happen there, and that'll be it, and it won't actually provide you an edge. That's what I think would happen, but there is no way for me to quantify it. So like, why even waste time thinking about it? But what you can do is you can say, I have a strategy and I'm going to take profits at a Fibonacci level or something like that. And then you can see how it works. But every time that I've tried something like that involving fibs in particular, it didn't make any difference. Sweet lemon can cure you. I think that I'm probably already cured and that my body is just still in that mode where the immune response is like way higher than it needs to be. What I'm getting out now is mostly just like really thick, almost white snot, because probably I'm blowing my nose too much and I'm getting dehydrated. Even though I've been drinking pretty good this morning. Do you think, this is in Discord, SPY should be traded off camera rather than trying to predict directionally intraday? Yeah, look, they made a little bit more progress. I don't know. I did favor the long pretty much the whole time. I guess I could have gotten 30, but that's a pretty awful trade considering how long it's been. Long session. That's a big iceberg right there. I'm going to clear up above me. Remember that 112.03 was kind of a point where there was like some big volume yesterday. Shouldn't matter anymore. But I can still kind of keep an eye on it. I find it interesting that I'm starting to see icebergs here again. So maybe there is some sort of order that's persisted between days that's going on there. Too early to say that. It could just be coincidence. Say things have... I mean, the treasuries are going pretty good, but things feel awfully slow at the moment. The S&P has started ranging here. Not seeing a lot of activity on social media. People are still asleep. They're not ready to get like full into the new year. Oh, what's this? Nassim Taleb has been active this morning. This UN vote shows how completely isolated we are from world opinion. It is only because America is smart enough to understand blah, 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 blah. Problem of lobbying and propaganda is that in spite of costing a lot of energy, they produce no cumulative gains. Once you stop the effort, everything. Okay, so he's saying that the only reason that the United States supports Israel is because of propaganda. I see things a little bit differently, but okay. A lot of slippage in the ES, really. We go into Friday FOMC. I find very little opportunities yesterday. I had 2 trades today, only 1. Well, in the treasuries, there was a lot of movement in the treasuries yesterday, but it's definitely still kind of got some of those hallmarks of, like, there's an FOMC on Friday, right? So it's like you got a big move, it retraces a lot. That sort of stuff. Like, it's frustrating either way. Jigsaw Trading pointing out that there's 200 coupons available, 2 days left to get $100 off on a Jigsaw license, or, you know, other things. Got discounts on all their products. You know what? Nassim Taleb has been a lot less interesting since he's started to get talking about the Israel conflict thing. Should we come? Yeah, I haven't checked Zero Hedge yet. Maybe there's some interesting stuff on there. Where is this from? Their top story is the system is not going to let Trump win. Dems' real puppet isn't Gavin, it's Nikki, Tucker, and Vivek. Oh, it's Nikki. Tucker must have been interviewing Vivek. That should be entertaining. I really don't like Vivek, to be honest with you. Driven by all the outward characteristics of Nikki Haley is identical in her priorities too. No, that's not true. But if the only priorities that you cared about was our support for Israel and our foreign policy abroad, then you would say that, because Nikki Haley is hawkish. I wouldn't call her a Trojan horse, but she's definitely like the, you know, the Democrats want her to win, for sure. For sure. I don't think that Haley would be a good choice. I would take her over Vivek, but I don't think she would be a good choice. In South Korea, more strollers were sold for cats and dogs than for babies. I think that you might start to see some of these Asian economies like South Korea and Japan really start to collapse, and it'll start to put the fear in the United States. The United States is in kind of a unique spot in that respect, because we are seeing demographic decline, but we're still getting a lot of immigration. You're seeing that in Europe, and you're starting to see the problems that are coming about with that. And so I think that the United States will kind of see that and hopefully catch itself before that happens. The issue is I kind of feel like the public has already kind of come that way, but there are things about this system that kind of encourage the immigration to continue. So, like, I don't know how far that can go. But demographic decline is definitely something to, you know, not a game, right? It's a serious thing that I think a lot of people are really underestimating, and you know, we should watch it and we should be concerned about it. Probably more so than climate change. To be honest with you, I'm more concerned about demographic decline than I am climate change. Let's say that. Whoa. Okay, so I thought that I had heard all of the names from like the Epstein documents stuff. But I'm here on Zero Hedge, like, here are the people, and one of them was Stephen Hawking and Michael Jackson. What? Their inclusion does not necessarily equal wrongdoing. Okay. Michael Jackson, did you ever meet anyone famous when you were with Jeffrey? I met Michael Jackson at Jeffrey's house in Palm Beach. The accuser said she was not forced to perform a massage on the pop star, perhaps because she wasn't a 12-year-old boy. Oh, God. Oh, my gosh. Dershowitz. This is the one where there's like, so she said that she saw Alan or that he was involved in something, but then she later said, I think that was I was mistaken. So it's kind of funny that everyone wants to still talk about Dershowitz, because I think that one's kind of been done and over with. Stephen Hawking participated in an underage orgy. Al Gore. He has not been accused of any wrongdoing. Bill Richardson. Yeah, Bill Richardson he's screwed. But he was already kind of under fire before, wasn't he? George Lucas, but this one was, did you ever meet him or give him a massage? And she said that she did not. David Copperfield was a friend of Epstein's. Naomi Campbell. I don't remember who that is. Kevin Spacey. Kevin. Yeah, how exactly did Stephen Hawking participate? This is a good question. I don't know who Naomi Campbell is. English model. Okay. Never seen that face. Don't look familiar to me. Donald Trump, who notably did not receive a massage. Yeah, that one was, they asked, oh, okay, so you met famous people. What about, you did these things for famous people. Did you do it to Donald Trump? No. There was like the one person that was like specifically rejected, denied, whatever. But they're still trying to make it into a headline about Donald Trump. The Black Panther, is that what? I don't know. I don't know who she is. What is she? She was mentioned. She was mentioned. The Times, they are changing how to trade the next algo shift. Ooh, that could be interesting. Soft surveys, services surveys hit source 5 months highs as hard data hits 2023 lows. RFK Jr. announces he will appear on the ballot in Utah. Okay. That's cool. We probably still have the laws in place that allowed Nader to get on the ballot back in the day. Massive whales dominated crypto buying in December. How did they see that? I want to see that. Goldman Sachs crypto team highlight. Goldman Sachs crypto team highlight value held across cohort group for BTC in December were mostly flat across the smaller cohorts, but increased by 3% for the largest cohort. Well, that's not all that big of a meh, kind of meh on that report. Have you seen how? Oh yeah, but they were. Yeah, that was from Zero Hedge. Yeah, there was the Unusual Wells did the thing about who was trading and the lawmakers. I wouldn't say that it was like the majority of lawmakers, but it was a lot of them were trading, and they beat the market by a big amount. Renshaw was one in particular on the right that made a lot of money from his trades. They need it's a conflict of interest. I don't consider it insider trading per se. I consider it conflict of interest. Congress should not be allowed to hold individual stocks. Once you become a congressman, everything goes into a blind trust. And that's it. Okay, Peter Tichier of Academy Securities. This is a good analyst. The times they are changing how to trade the next algo shift. We, the market, have collectively learned a few things in the last few years. Primarily, lower yields equals higher stocks. That was probably the single biggest lesson since COVID and zero interest rate policy. Lower yields equals higher stock prices. We learned that stocks are long duration assets. We learned that tech stocks are even longer duration assets. The everything or QE trade became a dominant theme. It didn't mean we didn't experience risk off days where the bond yields are lower but the stock prices are lower, or risk on days where the bond yields are higher but the stock prices are higher as well. They just occurred with less frequency, and they seem to drive the market for shorter periods than in the past. The traditional risk on or risk off made a lot of sense. If the economy is doing well, bond yields should be higher, but stocks should be higher as well, and vice versa. Like, bad news used to be bad and good news used to be good. Or in other words, ES and ZN would be inversely correlated. Right? I strongly believe that algos played a large role in enforcing this behavior of lower yields equals higher stock prices. While AI needs to learn and be taught, I think many algos are much simpler. They are like sharks, almost mindlessly and menacingly, mechanically swimming through the water looking for things to eat. This is neither an admonishment against algos nor praise for them. It is a simple fact about the market structure we live in. The algos that identified lower yields equals higher prices thrived. They likely bred other algos and certainly did well enough to be allocated more and more capital. As humans became committed to the concept of lower yields equals higher prices, the algos still had the first mover advantage, but that only helped solidify the relationship and possibly exaggerate it. Throw in stop losses and even 0 day to expiration options, and we live in a world where moves can be fast and large and often skewed to the everything rally trade. While the everything rally is far from dead, it seems very last year. I think sometimes when we go back and remember what the tells for the market were, we realize how varied they can be. Anything from Treasury, TIC data to some survey of bank lending, etc., and how short-lived many are. Geopolitical may be short-lived, but it is influencing markets right now. Let's start with yesterday's price action on the 10-year Treasury. Oh, yes, please. Treasuries tried to bounce in price terms right after the series of 10 a.m. numbers. Prices paid on ISM were better than expected. A weird piece of data to gloom on, but it seems to excite the inflation is over camp. I used to be a card-carrying member, so I can relate. That's funny, Peter. JOLTS seemed to confirm last month's surprising drop in jobs available, and the quit rate was lower while the hire rate was lower, both bad for those looking for the bottom of the employment cycle. But that move was short-lived. Yes, it was. Markets were fixated on the FOMC minutes due out at 2 p.m. Treasury prices initially declined and then resumed their march higher. Maybe that could all be explained from the reaction of the FOMC minutes, but I believe something else was at work here. Treasuries were marching higher from about 11 a.m. until 2 p.m. Was that all in anticipation of dovish minutes, or was something else going on? Like headline after headline about bombings in the Middle East, that was on top of previous headlines about warships and supply chains. So was they buying because of geopolitical risk? We've tightened up the chart to just yesterday's trading. Yeah, this is exactly what we saw. He was pointing out that oil kept rising and stocks limped into the close, and the treasuries kind of like, you know, they moved up. If this was an everything rally, stocks should have done much better than they did. They failed to pop on ISM jolts, but more importantly, they faded as treasuries rallied all afternoon, and stocks certainly didn't behave as though the FOMC minutes were dovish. Oil popped earlier in the day and were bid all day. Economic news was definitely not good for oil, yet oil was higher. He thinks that the reason oil rallied yesterday was because of geopolitical risk. He didn't outright say that, but that's what it sounds like to me. Anyways, enough reminiscing about how things were, and let's think about how to think about moves in today's world. In a world where geopolitical risk is high, markets don't seem to care that, according to reports, Xi says China firmly supports Iran and safeguarding security, which doesn't seem good, especially given how much oil is allegedly finding its way from Iran to China. I think we can start with the safest signal, oil. Oil will rise and continue to rise as tensions intensify. Well, that's a great theory, except for that, you know, we've had some pretty big declines in oil lately. The biggest risk from my perspective is that the U.S. hits a point where it feels forced to curtail Iranian oil shipments. That's a good point. At some point, if this occurs, the Saudi may increase production, but that is unlikely to occur below $90 a barrel. I'm looking for oil prices to continue to move higher as shifts from traditional supply-demand story to geopolitical interference risk story. I do like an energy company stocks even better than oil, but both should work right now, and they are a major tell. I don't know. I think that on that one, like the probability of that event happening, I would say it's still like a minority event. Like I'd say maybe there's a 30% chance of something like that happening. You know? I like energy companies outright, so I'm almost getting the geopolitical risk for 3. I do not like the stock market here as per previous T reports, and I think higher energy prices, especially as a direct result of geopolitical tensions, will weigh on stocks. But what about bond yields in their own right, and how will they impact stocks? Do not expect lower bond yields to be good for stocks. Bond yields are not going to be the main driver, certainly not every day for stocks. Geopolitical risk is going to be a bigger factor, and that will outweigh the impact bonds have on stocks. If anything, we should see more, quote, risk on and risk off days, but look for some other signal to drive stocks, as the bond stock correlation isn't the same as it was for much of last year. You're extrapolating a lot off of one day's action, dude, but he's making a really good point. And it's kind of in line with a little bit of maybe what we were wondering yesterday, although I still feel that the way that the treasuries in particular moved on that day was a little odd. Confusing. That was on the sell. I don't know what the sell was. The buy, he says it's geopolitical risk. I thought it was going to happen anyways, and it had nothing to do with that, so I don't know. As oil prices go higher, will the Fed really shift to an easy money stance like they normally would in times of geopolitical stress / uncertainty? I do not think so, at least not initially. As tensions escalate, munitions are used. As military activity across the globe increases, concerns about spending will rise. Now back to China TIC data. If China continues to deplete their inventory of bonds, largely through maturities rather than active selling, will that come back into focus? The worst outcome might, and one that I think is increasing in probability, is that we will see higher yields, higher oil prices, and significantly lower stock prices. I do believe that is a possibility. If the algos that made all of the money by buying stocks whenever bond yields went lower start losing money, they will be shut down or constrained rapidly. What happens when the geopolitical algos, trained or designed to trade geopolitical risk rather than Fed risk, gain in prominence? At exactly the time humans become concerned about this positioning seems to set up trigger stock losses. Sentiment seems to be skewed towards being long stocks and long bonds and neutral energy after that trade struggled much of last year. Bottom line, the times are changing and change with them. I'm the most bullish I've been on energy in some time, and the most bearish I've been on equities. I'm targeting 4,500 on the S&P sooner than later. Credit spreads will widen in sympathy with equities, although this is largely an equity valuation and a setup problem. The setup being the condition to lower yields, higher stocks, so credit should outperform equity quite handily here. On bonds, maybe, just maybe, we get some flight to safety trades, so I'm only mildly bearish on bonds right now, but we'll sell it any rally in bonds, as I think the problems facing the bond market from the geopolitical risk will outweigh the traditional safety bet. That is a really, really bold prediction. I have never seen it play out that way, where you get geopolitical risk and yields rise. Never seen it. And I'm also very, very skeptical that the geopolitical risk is like moving towards a full-on war with Iran. You know what I mean? So, but there was an interesting story. I think the interesting thing about that story was that he thinks the bid in the bond market was because of geopolitical risk. Okay. Do you know why all the mumble rappers are beefing with each other? I don't know. There's this whole thing with Taylor Swift and Kanye West, and that they asked her if they could put a thing about her in their song to try and create a beef that would create publicity, and there's like a miscommunication there or something. Like, you get like one celebrity that starts to do this thing, and it's like, hey, you can do this and it actually helps you. And it's just like spreads like a virus, and I would if I was a celebrity, I would recommend you to just not do that. It's not worth it. Maybe the S&P by a large margin. Why aren't those guys? Are you talking about Congress? Well, you saying that I was mumbling? Huh? Wait, what are you getting at, Jiwi? Huh? Well, it's about time. Still at 112 even. Listen, I didn't take a trade, but I did call it. Like, will we come up to 112 even? I was like, we got a liquidity hole here and here. We might get stuck. Well, the market should be free to move. The market should be free to move, but I don't think that they have any reason to. So, off topic, but how can you type really fast? Shall we do it? Time to show off. Okay. Typeracer.com. Enter a typing race. Let me make this bigger. Oh, I'm a little slow today. 90. I could probably go a little bit faster than that, but I did make a little mistake at the beginning that was kind of critical, right? Pretty good. Yeah. For like not being warmed up or practicing or anything. 90 is pretty good. Somebody beat me though. That's pretty good. From Canada. To make your life easier, can you possibly develop a study for all the DOMs on your screen that tell you when liquidity holes are occurring? You know, I've thought a lot about that, and I just don't really know how to quantify it, you know? Because the issue is it's like, how much does it take to make it tick up or down? And you have to see that over several ticks. You know, you're just going to see that, like, it's going to move up or down on, like, 700 or less contracts multiple times and just stays there. So it's really obvious once it's been stuck there for a while. You can kind of start to see it happen, but it's just sort of a thing that I just kind of get a feel for, and I'm not sure I completely understand how I see it when it's occurring. But, you know, I describe what it is that's happening and why it happens and what I'm looking at. You'll see it. And you know what? If you did have an indicator that could like show it to you, it might do more harm than good, because then you wouldn't watch it as closely, right? One thing that you can do is a large transaction kind of makes a liquidity hole more likely to happen. So like if you're having like, you know, a pretty good uptrend and then all of a sudden there's like this huge 10K trade somewhere or something like that, that tends to like really cause price to consolidate there. Yeah, you have to go. It's time for me to get going too, so we will tight range ahead of FOMC. Now let's say, are markets pricing geopolitical risk? Question mark. Markets. It's a good open question for us to watch. I think he's got a good point that, like, you know, the algorithms are all kind of set up towards this one thing, and it might do something different. But I don't think that geopolitical risk wouldn't necessarily push bond prices higher, or bond yields higher. I would be really perplexed if that happened. But at least now we know it's a possibility, so if it does happen, we're not caught off guard, right? Okay, guys. I will see you tomorrow. Big day, FOMC. Not FOMC. Non-farms.